Hi, good afternoon, everyone. మీకు ఆల్రెడీ ఇంటిమేట్ చేశాం కదా ఒక లైవ్ వీడియోలో లైక్ మనం P2P లెండింగ్ గురించి ఇన్ డీటెయిల్ గా నేర్చుకోవడానికి ఫౌండర్ ఫేస్ అండ్ ఫౌండర్ ని ఇన్వైట్ చేశాము. సో దీని రిలేటెడ్ హీస్ గోయింగ్ టు టేక్ ద చార్జ్ అండ్ హీస్ గోయింగ్ టు ఎక్స్ప్లెయిన్ అబౌట్ ఇన్ డీటెయిల్ about phase end. I think you guys might be like might attended the same session sometime before, like 1 month before. So here that session was given by one of the trainer, but here this session is given by directly founder. So there is lot much scope to learn much about it. So you guys can ask much questions after the presentation. Okay, I am inviting Vinay to give the presentation. Hi. Hi, Vinay.
Hey, hi, Vasu. Thanks for having me. It's an honor to be, fantastic work that you guys are doing. It's an honor to kind of be here and talk to people, your people that you've been associated with for quite some time now. I'm not from a financial services background. I was an internet person, and all my life I have. I'd run internet businesses, so it's not so the financial services don't come naturally to me. But having said that, for the last 8 years I've been doing this. Today I know a lot more than what probably some of the people who are sitting in the large banks, because we kind of do this the fintech way, and which has kind of propelled the way that Faircent has grown in the last many years. I have a small presentation here. So what I'll do is that I'll try and present that. So that will give you a little bit of clarity with respect to, as a business, what we are, what we do. Also, how is it that we manage the risk or mitigate the risk? Because that's, I think, one of the most important things for all of us who are on this call to understand. We will also talk about a product which we had introduced some time back, and that has become quite a sensation in the market. There's a lot of excitement that from that particular product, which we've seen in the last 2-3 quarters. I'm going to talk a little bit about that product also and how it's performing, and that's exactly the product that we are giving to Vasu and team here. Okay, so quickly, my introduction. I have been in the internet business, as I said, and this has been, in fact, my journey started long back, 25 years back, with a company called Rediff. Rediff was a market leader with respect to, the .com. During the .com days, they were the market leaders on the horizontal side, and from there I moved to a company called Sifi. I spent some time in Sifi, and from there I moved to the Times of India group, and I ran a business called Times Jobs there, and from there I quit and started Faircent. Okay, so the model and everything pretty much is similar to what the Times Jobs or any of the horizontal portals that you look at today is it's like. So I'm going to talk about that piece as well. How how I relate this with that, and why is it that this will shape up the way it is, the rest of the internet businesses have gone through, right? So Vasu, one request, so I'm still getting a lot of people coming in. So if you could, take that charge to admit them, will be great. It disturbs the flow of my thought process. Is that okay?
Actually, yeah, I will take care of it. This is having a 100 people limit, so we are giving YouTube live also the same.
All
So
right.
yeah, we are directing them.
All right. Great. Okay. So let me put this out. Faircent is basically, a two-sided marketplace. What it means is that we have on one side individual people coming and borrowing money, and on the other side we have individual people coming and lending money. So this is a new thing, and why this is a new thing? Because globally people were doing this, but there was no structure, there was no technology, there was no organization which was trying to do this, right? So this is how the structure got created. It's not that Faircent has created the structure. The structure was created in 2000, I think 5, by a company called Zopa in UK, and from there it moved to US, China, parts of Europe, Latin America, Australia, everywhere it moved, and kind of it came to India also. In India, it kind of got regulated, 3 years back. RBI regulated this business. So we were the first one to get the NBFC license. In fact, this business was started by us in India. We started in 2013, and we were building out the tech part, all of that initially. And 2018 is when RBI regulated this. You put out a white paper, all of that. A lot of discussion happened around it. The Ministry of Finance, the Corporate Affairs, all of that got into and kind of put out a regulation around this. Now, one of the reasons they wanted to kind of do this quickly from a regulation point of view is because it was individual people money which was coming in, getting together within an organization, and from there it was kind of getting given to the borrowers, right? So this was traditionally done by the banks. Okay, so technically, if you look at it, we are kind of taking public deposits and you're kind of moving money to kind of do loans, right? So that's it. So the RBI wanted to kind of make sure that the risk from the investor's point of view is completely taken care of. So okay, that's the reason I think they regulated it before it kind of scaled out and all of that happened, right? So it's important. This business comes from the sharing economy business. India has seen a fair share of growth in the sharing economy business. Sharing economy is nothing but when people start to kind of do commerce within themselves. It's called a sharing economy business, and this has grown in the last 15 years in the world, and it is growing at a very rapid pace. For example, if you have a car, you can attach yourself with Uber and make money out of it, right? Similarly, if you have a house, you can give that house a part of it and make money out of it. Similarly, if you have money, you can give a part of that money and make money out of it. So that's what sharing economy is. So this business also fits into that economy, sharing economy, and it is kind of growing very, very rapidly. It's kind of getting into a lot of places where people are doing transactions, right? So it's important to realize this. Like mute. So the other important thing is that when you are knocking off the incumbents, right? So for example, when I take a loan from a bank, okay, this money is coming from the public deposit goes to the bank, and and from there banks lends it to me, right? And if I'm taking it from an NBFC, it kind of moves from public to the bank lends to an NBFC, and NBFC kind of gives the money to me, right? So it is changing hands 2 or 3 times, right? In that process, what happens is that the cost of the capital goes up, right? So a platform like this, what it does is that it kind of takes care of that incumbents, and gets people to kind of directly lend to people, right? Rest everything remains the same, right? With respect to how we look at risk, how to kind of manage the flow, money flow, all of that, remains the same. It's just that the source of money directly goes from the lender to the borrower. Okay, so that's the fundamental thing. And most of the businesses that you see in the internet space has threatened or taken that in the view while building that business, right? So the incumbents and the middlemen have always been the people who had lost out in this process. So the money kind of moving from customer to customer directly, right? So that's why this is important to understand, right? So what it means is that you get a cheaper source of credit from a platform like ours. Borrowers get a cheaper source of be it individual or business borrower, they get a cheaper source of capital from our platform, and that helps, right? So for example, for business, it is important if you get cheaper source of capital, you can conduct your business better than if someone gives you a very expensive cost of capital, kind of makes the business unviable sometimes. So it's important to kind of have a cheaper source of capital going, right? Also, the entire thing is very fair and transparent because this is in the hands of user, it's in the hands of the people, right? Just like any other tech platform that you use, you exactly know where your Uber driver is, how long he's going to take, what's his name, what's his number, what's his car make, all of that you get to know, right? Also, when you go to shop on Amazon and any two-sided marketplace, right, this phenomena is common. When you go to kind of on Amazon, you'll exactly know the product, the dimension, the kind of boxing, the weight, the color, all of that you get to know, the price, all of that. So that transparency gives a lot of trust, and that's how the user gets binded, right? So the transparency gives trust, and trust is what gives repeat purchase on the platform, right? And if you see internet businesses, you'll not find more than 3 or 4 players, or at best 5 in any given category, right? So for example, shopping, you have Amazon, Flipkart, maybe a Myntra. So you will not be able to name more than 5, right? In any category, be it shopping, be it travel, be it food delivery, be it cab hailing, anything, So it's kind of very limited, and that's because the market leader takes a sizable amount of market share, right? That's important to understand. And we are a very tech-based platform. Most of the things that we do is through APIs, which is basically, and there's a lot of analytics that goes into the business that we do here. Also, the APIs help us to kind of understand the borrower better, and we not rely on what borrowers are giving us. All these APIs are third-party APIs. So there are hundreds of APIs that goes through validating a particular borrower. And also we have partnerships, on both sides, lending side as well as the borrowing side. We have a lot of partnerships. These partnerships bring in, lenders and borrowers to us, right? So we are a very thin, mean team, sitting out of Gurgaon, very lean team sitting out of Gurgaon. And some of our, people are spread, the sales people are spread across India, but otherwise, majority of the people sit out of Gurgaon. And we do all of this through technology. Okay? So that's the important point. So that's the reason partnerships is a very important piece. And we make a lot of partners on the lending side as well as on the borrowing side. Okay, so quickly the key highlights. We have till now disbursed close to 2,500 crores. We do approximately 120 crores a month. COVID has kind of brought this down a little. Otherwise, it was around 150 crores that we were doing. We have processed close to 2 million customers till now. We process approximately 75 customers a day, right? So this is both individual as well as the micro SME borrowers, right? We have 2.5 lenders on our platform. These are individual people who come and lend money. At any given point in time, 25,000 individual lenders are active on our platform. Either they're buying borrowers or they are, taking away the money that they have received as interest and EMI, all of that. So that transaction volume is an activity of at least 25 lenders at any given point in time, right? We believe we have 75% of the market. And why? Because we get to know this figure through the disbursements that we do. There are some common trustee that we have. We get to know from that. Also, partners give us a lot of information about how much money they have parting with others and how much money they're parting with us, right? So we get a sense of the market. So we are pretty dominant that way. And we continue to kind of grow this as quarter on quarter as we go forward, right? We have done in the last 12 months, this is in spite of COVID and all, we have done 2.5 lakh loans on our platform. We disburse close to 1,000 loans a day, around 25,000 a month, right? So that's the averages that we do. As I said, we had lending partners and the borrowing partners. We have lending partners 800 plus, right from ICICI Securities to JM Financial, SMC, Cube. So a lot of partners there. And on the borrowing side, we have partners who bring in borrowers to us, captive borrowers. So there are aggregators, India Lens, Bharat, Paisa Bazaar, Bank Bazaar. All these guys, give us captive borrowers. Also, we work with a lot of organizations to bring us captive borrowers. MobiQuick. We work with Oxygen. We work with Pay1. We work with various ecos. So a lot of organizations give us captive borrowers. Their customers becomes our borrowers, and we look at the data, figure out, understand, and kind of process the applications. So so quickly coming down to the fundamental thing which everybody would have in terms of the questions. How is it that we as an organization or a platform mitigate risk? Okay, so fundamentally what we do, because as I said, we use technology a lot. So fundamentally that we do is that the principle of risk, there are some basic principle of risk we have used, picked that up, and we use technology to kind of cover that. So the first thing is that the loans on our platform, varies between 1 day going up to 36 months. So it's not like a standard three-year loan or a 2-year loan, right? So we have, daily loans, we have weekend loans, we have, loans for, 30 days, we have loans for 3 months, 6 months, and going up to 36 months, right? That's one. And the reason for, these short-term loans and long-term loans is because, different types of loans have a different kinds of flavor, risk, the stability, all of that attached to it. So that's the reason it is important to kind of have that, right? The other thing is that our interest rates range from 10% going up to 36%. So there is a high-risk customer also that we look at. We believe that, he will pay up. Not all of them do. There would be a bunch of, customers who will not pay. But it's important to kind of look at that risk is because at an aggregate level, let's say if I'm, investing in 36 or 30% and above, even if there is, 10% or 12% or 15% default, you still end up making, 15 or more than 15% return, right? So it's important to kind of, at the end of the day, realize that lending is a business where you lend, the risk-based pricing that you pick up and kind of do, you at the end of the day have to kind of make money out of it, right? So that's the reason we kind of move the bar to up to 36%. And also there are customers at 10%, which is not heard of. Even HDFC Bank or ICICI Bank cannot match a 10% rate of interest. We do that. We do a lot of customers on our platform. We also have loans. That's the other strategy. From 600 cities. Now this is by design. It's not that because we're using technology, so there's no problem for us to kind of go across different cities. The limitation here is only that wherever our partner who is doing verification all not working, we don't work in those cities. Otherwise, pretty much, we work with, we work around 600 cities across the country. Okay. Now, this is a very important, risk criteria, right? So if you look at it, some of these organizations have built business. Let's say if they're based off Hyderabad, they've just kind of focused on Hyderabad and build Hyderabad, right? So Bombay, they kind of just build Bombay or Chennai or Delhi or whatever. So one city they have kind of scaled up and then kind of moved to the other city, right? That's a great strategy as long as you are a non-internet business or a non-tech business, right? Because what happens is that in one particular city concentration, you run a lot of risk. For example, we saw that in COVID, a lot of NBFCs shut shop because of concentration in, let's say, Bombay or Pune or Chennai or Delhi, because these states were kind of, or these cities were hit very badly. Okay, so for us, our distribution is very, very thin. Bangalore is the largest market that we have, and Bangalore occupies just 3% of the total share of the volume of business that we do. So you can well imagine the kind of spread that we have with respect to the number of customers that we procure from or onboard from different cities, right? The other strategy that we use is to kind of make sure that we are not fixated on one particular industry, right? We are looking at this as a true horizontal. So we pick up customers, from various segments and sectors and needs. So we have consumer loans, we have microfinance loans, we have medical loans, business loans, education loans. Every loan has a different risk element to it. Okay, that's the reason this is important. Rather than focusing on just one microfinance loan or just one business loan, what happens is that, again, same story. If that particular sector, that particular industry, that particular area of borrowers or needs, if it is not there, then the business goes bad. For example, one of the use case that we saw that recently is that one of the medical medical lending companies that we had tied up with during COVID, they went completely slow because a lot of procedures and everything people started to delay, right? And they were not. So the business really went down. Okay, so we didn't have that problem. We kind of cut across different industries, different verticals to kind of bring in borrowers. As I said, we also have captive large organization giving us borrowers, and there again, the strategy is not to fix ourselves in one particular type of domain. So we pick up from MobiQuick, we pick up from Propelled, which is an education client. We pick up from, let's say, A1, which is a wallet company. Eco, a PPI license company. So we pick up kind of borrows from different organizations. Myntra, which is a shopping company. So we pick up borrows from different kind of organization, which again kind of cuts out the risk for us. So we do not expose our lenders to more than a certain percentage in any organization or any type of industry or segment that we are catering to, any type of segment that or any type of tenure. So we are pretty much widely spread that way, right? The other important thing is that this is the most important thing is fractionalization. Okay? So the money that we put out to our borrowers from the lenders is fractionalized to smaller units. Right? For example, if you need if I'm the borrower, if I need ₹1 lakh, and if you're the lender and you're the one who's getting in on the platform with ₹1 lakh, you don't give me that ₹1 lakh to me, right? So what happens is that ₹1 lakh is broken up into multiple units and it kind of goes to multiple borrowers. Okay, so otherwise, or the you pool into a particular corpus, and from that corpus, that pool distributes that money to a large number of much larger number of borrowers. So your money is valued, or the money gets broken up into very small units. So on the current platform, if you go directly onto the platform, it's broken up as small as ₹500, and it can go up to ₹5,000 to any borrower that you're investing, depending upon the risk. But if you're doing it to a pool, it can further go down to ₹50, maybe not ₹20. It's as that much, right? So that really picks up a lot of borrowers for you for the ₹1 lakh that you're getting in with. And in this business, it's very important to realize that more number of borrowers that you pick up, the more stable your portfolio or the more stable your returns will be, right? And what is it that we do? Okay, so what we do is that before we take the customer live on the platform, okay, any borrower, we curate the customer through technology. 80% of the customer happens through technology, and they get weeded. They don't even get into the system, right? For example, we curate the customers on the CIBIL score. We curate the customer on banking. We curate the customer on age, on the city, on education. So there's a lot of cutoffs which happen. Also, there are certain rules that we have set with any partner that we work with. We have set some certain rules, and that rule applies. Basis that rule, those customers only get in. For example, anybody who has defaulted any time in the past do not get into the system. Anybody who is delayed, a certain period of time, up to only then he can get in. Otherwise, he can't get paid. Anybody who's in the bureau less than 2 years, do not get. So, for example, we do not give out to kind of customer who's just got into the bureau, just started lending, in the last, or started borrowing in the last, 6 months or 1 year, right? So we look at least a two-year bureau vintage. So there are certain rules. Those rules knock off 80% of the customer at the technology end, at the partner end itself, right? The 20% customer who gets in, their data is validated to third party. Basically, we're trying to understand the ability, stability, and the intention of the guy to pay back. A lot of intentional thing comes up by looking at the bureau. We kind of get to know what's the kind of loan he has taken, how many credit card he has, personal loan exposure, how many times he's made inquiries, various things, right? So we kind of look at that. We also look at, in some cases, behavioral data. We look at psychometric data. We look at mobile data, financial. data. So location data, that also is very important. So we look at a lot of data before we kind of thoroughly look at all the data of the customer before we onboard the customer, right? Once the data is validated, it kind of goes through a rule engine, right? A rule engine is nothing but it kind of scores you basis every parameter a borrower is looked at, and those parameter forms a score, and that score is what defines how much of money you can get, at what rate of interest, and what is the tenure that you can avail. So this rule engine is matured over a period of 5-6 years now, and maturity comes with a lot of data moving in, right? So you get a lot of data, you kind of chew that data, you process that data, you do analytics on that data, and kind of go back and reset the rule engine. Some weightages go up, some weightages come down, some of the weightages are taken off, and new weightages are introduced. All of that comes with more and more data you process, right? And every event also kind of does that for us. For example, a COVID event, you're better prepared and better done if you have past data, a lot of past data. It kind of makes more sense to kind of churn that data to figure out who are the next set of people who might go bad or who might go slow in the event of COVID happening again, stuff like that. So the rule engine is nothing but an intelligent software which is learning itself over a period of 5-6 years, learned a lot, and our ability to kind of predict is somewhere around 84-85%, with respect to the rule engine. So that's the kind of level of prediction that we are able to do with this. Once rule engine passes, it kind of moves to the next step, which is the risk analysis part. Basically, there is a manual check. There is the manual check happens by the underwriters who are sitting in our office. They kind of call the customer. They try and figure out what's happening. Try to kind of validate much more. Try to kind of understand a little bit more about. Basically, trying to qualify whether the customer is not gaming the system and all of that, right? So that conversation is also important. It is not entirely, technology or, straight through process. There is a little bit of manual intervention also. Similarly, on the, verification side, we do verification. We do physical verification if the ticket size is more than 2.5 lakh rupees. We also pick up checks if the ticket size is more than 2.5 lakh rupees. So there are a lot of physical part also, checks and balances, which is there to ensure, the borrower that we are onboarding is the right borrower, right? Only after doing all of this, the left-hand side, what you see this, the borrower goes live on the platform, okay? Once the borrower goes live on the platform, the data is shown very transparently to the lender. And you can look at various options. You can fund the borrower, and once the borrower gets funded, the loan gets initiated, and an agreement gets initiated, and the process kind of closes there. And from there, the kind of money starts to move. Now, this is an important piece you have to understand. This entire money movement which happens is through an escrow mechanism. Okay, so which means that there is an escrow account FairSend runs. Okay, it's a FairSend escrow account. And under that FairSend account, there are multiple lender accounts. Okay, everybody has their own account. Okay, it's just like a Paytm wallet. Okay, so there is a Paytm. Under that Paytm huge umbrella, there would be multiple wallets. Right. Similarly, within the FairSend ecosystem, there will be multiple lender accounts. Every lender who's coming out of the platform gets an account in this particular escrow mechanism. Right. The money that and this escrow account is stitched with your bank account. So any money that you want to kind of move in, you can move in through this from your bank account to this particular escrow account. And this will lie there as long as you want to kind of invest in any borrower. Okay, it is not going anywhere. It is in your control. Just like the payment wallet, as I talked about, Paytm wallet, it's in your control for what you want to buy and what you want to kind of push it out for. Okay. Now, if you make that instruction, okay, and this is very, very particularly for us, right? For the P2P industry, right? Wallet does not work like this. The Paytm does not work. So any instruction that you do, for example, you say that I want to kind of fund this particular borrower, or I want to kind of put money in this particular pool of borrowers, whatever that you instruct, right? That instruction, we pass it on to trustee. So we have a trustee. He's the one who kind of has the control of the account. IDB as our trustee. We don't have any direct access to the money, right? So, and trustee instructs the bank, and then the money moves to the borrower. So it's very tightly managed here, right? So trustee is nothing but a third party There are very few trustees appointed by the government. Banks, in banks there are trustees. Banks can be, some of the banks don't have. Large banks have trusteeship. Apart from that, there are very few trustees, and 3 or 4 trustees, in the country. This license is not given out so easily. You have to have either you have to be a bank, or you have a large bank, or you have to be of a particular cadre or a stature to kind of get trusteeship, right? So it is basically that people are trusting this particular party with my money. Okay, that's the reason. So that kind of authority you should command to be a trustee. So IDBI is our trusteeship. So the money moves through their instructions. So they are the ones who instruct the money to kind of move from point A to point B, right? So from from lender A to lender borrower B. So what it means that on this side it is stitched with the bank account of lenders, where they pull in the money in the escrow. On the other side, the money moves from the borrower's escrow to the borrower's account, right? Personal account, right? Now, and that particular personal account is what is stitched with the escrow account, main escrow account, on the NAC and the checks and everything, right? All the repayment, everything happens on this particular escrow account only, right? So what it means is that even if you don't exist tomorrow, this money is not going anywhere. It is tightly managed by the government. It is not going anywhere else. This money remains in this ecosystem only. Okay, that's a good part. So this was one of the important pieces in the regulation which the RBI had put out. The other thing that we also do is that we take care of the collections. Any delay, any default, all of that we kind of chase. We have agencies also for that to help us. So we do the entire mile of calling, sending the legal notices, filing a case, all of that, right? End to end we do till the customer is declared either bankrupt or they have a word called his run away, right? So those kind of things are also called onto the particular borrower, right? So we kind of do the entire. So we have an in-house legal team, we have an in-house collection team. In fact, a collection team is one of the biggest in the entire scheme of things, right? Even bigger than the tech team that we have. Okay, so these are the things that we do before and after the borrower takes the journey with us, right? Now, quickly from a technology standpoint, I'll just explain how this works. Most of it we have covered, but I'll quickly, So one thing is that we kind of knock off the customer, as I talked about, and select the borrower's basis, age, income, location, employment status, etc. Once he's digitally onboarded, it kind of move to a process called segmentation, right? This is what I was talking about. So we kind of give a very sharp bureau segmentation, which excludes the bad borrowers. We kind of are able to kind of figure out, understand, and we also use multiple bureaus. It's not just one bureau that we use. Top of the funnel, we might use one bureau. And as the customer progresses, we use another bureau to kind of figure out the customer. Sometimes bureau reporting, there is a lot of delay. So that's the reason it's important to kind of have multiple bureau approach, right? Once the customer is segmented, it moves. So segmentation also helps for me to understand who's a customer, large customer. For example, a customer with 2 crore house and a 10 lakh rupee car already kind of which is visible on the bureau. Once he's coming and kind of looking at a loan of 5 lakh rupees, compared to a customer who has a 50,000 rupees bike loan and he's a 25,000 rupee credit card coming to look for a loan of, let's say, 50,000 rupees, right? So I know who to prioritize and I know who to kind of take additional documents from. All of that, the segmentation helps me, right? And from there it moves to the rule engine, which I talked about. There are 100, 200 variables there, and all these variables are run. All the data points are looked at to kind of figure out the score of the particular borrower. And from there it moves to risk mitigations. Now, risk mitigations is something which is all third-party APIs that we look at to understand borrowers, his identity check, his contactability, employment check we do through EPF office. We do the bank statement analysis through a third party, whether the bank statement that is given is fraud or not fraud, or all of that. The prosperity index, where he's living. Is he living in an affluent area? Is he living in not so affluent area? So all of that, we kind of try and figure this out, right, through the risk mitigation APIs, right? And after that, if we find, and at every level there is a drop of customers, right? And if we find at every level, if the customer is okay, it kind of moves to the next step. And once that happens, it moves to the final step, which is the video verification step. We do video verification. We kind of pick up the lat long liveliness. We pick up references. And video verification is far better than physical verification sometimes, because you can actually get into the customer's house, move around his house. You can ask him to kind of move around his house. You can see his kitchen. You can see his rooms, all of that. So it kind of gives you a better sense rather than somebody coming and standing on your doorstep and trying to kind of get information, right? So he's also allowed us to kind of show his PAN card, his Aadhaar card, all of that. He has to show it on the camera. He has to take a selfie. This selfie is matched with, it's a face matching technology here. The selfie is matched with the initial documents that he kind of submits to start the journey. If it is not matching with those documents, the customer gets rejected. All of that happens, right? So at that point. And before we disburse, there is a penny drop which happens. That also is happening at this stage. A penny drop which happens, which to verify the borrower that he is taking money is the borrower that has started the journey with us. It should not be that wife is, starting the journey and the money is going to the husband's account. So we don't do that, right? So it's important whoever that we are qualifying or verifying, the money goes into that particular person's account. Okay, so is there a way to kind of take this off, because this is kind of a little disturbing.
You need to unshare and share again. Stop sharing and share again.
Okay. Let me just try that. Okay, so this comes on my screen. Huh? Okay, not bad.
Yeah, someone wrote on that.
Okay, someone got excited, I think. Yeah, all right.
Yeah.
So now, one of the things you have to kind of remember or realize in this business is that the risk that you take on picking up borrowers, the return is not proportionate, in the sense the risk is sometimes geometric in nature, right? So for example, if you are picking up low risk borrowers, which is typically between 10 to 12%, you can safely assume that you'll make 10%. And for that, you can just pick 100 borrowers. But as you move the risk, if you're picking up high risk borrowers in the range of 18 to 24%, you have to pick 10,000 borrowers, right? And which can yield you 12.5% return, right? Now, what happens is that if you're moving beyond 24%, which is maybe up to 36%, whatever, you have to pick up a lakh of borrowers to get you 14%. Now, what it means is that if you look at on the left-hand side, as the risk is climbing, the return is not climbing that way, right? It means there is a delinquency which happens, and it is not possible. Now, what happens is that people get greedy and kind of move to this side immediately, right? They want to kind of more returns and all that. Now, unless and until you're picking up a lakh of borrowers, you'll not be able to make 14%. Now, this is not possible technically. Humanly, it's not possible. Technically, it's possible. Humanly, it's not possible because it needs a lot of time, energy, and bandwidth to kind of do that. One. Second is that there is a lending limit RBI has put, right? The lending limit of 50 lakh rupees per user or per lender or an individual who can come and lend on the platform, right? So also to kind of get to these a lakh of borrowers, maybe your money might fall short. I don't know. If you're smart enough to kind of break it down too well, then you will get. But time definitely you'll consume a lot of time. So it's important to kind of realize this. And this has come about, a realization come about after looking at data for the last 8 years, right? The best way to kind of make your investment work is that increase the number of lenders as you go about proportionately, not arithmetically, but geometrically as you move or climb the risk, okay? If you're not doing that, chances are that you might lose money, you might lose principal, right? So it's important to kind of realize this rule, right? And someone is not trying to kind of explain this to you, I think is not doing the right job. Now, so that is the reason we had introduced this new thing, or new product, which is the SIGP, right? So SIGP is systematic investment or income generation plan. So what it does is that it offers our lenders a non-volatile stable return. Now, what it means is that it's not that one lender will make 24%, the other lender will lose money. Okay, so it's not going to work like that. It's going to work that all of you will make the same amount of money. Okay. Now, this is a safer way because if you have to kind of make larger money, you have to kind of put larger number of borrowers and more money, right? Maybe you have to introduce 3-4 PAN cards and kind of go to a ticket size of 2 crores and all. Then maybe it will make sense. But otherwise, it's always better to kind of go the non-volatile way to kind of make money on this platform, right? So what we do is that we kind of look at the borrowers, which I talked about. Analytically, we look at borrowers, and this program is also completely analytical based. We leverage that data to kind of pick up the right sort of borrowers for our lenders, right? Now, this also reduces the lender's time spent in picking up borrowers. Okay, so your problem is solved also on the borrowing side. The borrower gets funded immediately. Otherwise, borrowers have to wait for lenders to fund, right? So that problem also gets solved in this, right? Lastly, there is transparency. You can actually see where your money has gone, which borrower that the money has got deployed. All of that you get to see because you get to sign loan agreement with all the borrowers. All the borrowers will come to you. However, whatever number of borrowers that you pick up has nothing to do with the return that you're going to get. The return that you're going to get is going to be the average return of the portfolio, what has performed. So what it means is that the moment you put money, pick up the borrowers and put in the money, it's dealing from there. And Fairson takes over from there, and it kind of makes money for you. And whatever money that it makes, it kind of passes on to the lender. Right? So it is important to realize that the portfolio, the way it operates or it works, is the barometer through which, and also we looked at return on a holistic basis. Because over the last 8 years, what is it that we have made money out of, right? How much money we made across? So we've made close to around 14 to 15% for our borrowers over the last 7-8 years of our operation, right? So from that point of view, we have calibrated this data and figured out a whole lot of them have made money, but some of them have lost money. Maybe 5-10% or maybe 15% of people would have lost money, right? But 90% of them, or maybe 85% of them, have made money, right? Now, so what happens is that someone who loses money, he goes out and he's kind of bad mouths us. He's having a problem. He goes Twitter, all of that, right? So that's one of the reasons we introduced this product. So it solves a lot of problems, for the organization. So it cuts out a complete the conversation between the organization, the people within the organization, and with the customer, right? So this is a pretty straightforward one. So in this program, what we are doing is that we're giving a return of 12% to our lenders. This is flat 12%. So if you put $1 lakh rupees, you'll get 1,12,000 at the end of the year. Right? There are two options in this right now. We just introduced a third option also. The team can tell you that also, but the rollout is yet to happen. We have a 6-month option and a 12-month option. The 6 months will give you 11% annualized, which is 5.5. And there is a 3-month product also that we have introduced, which is around 10% annualized. Okay? So whatever is that calculation for 3 months, right? And the return and the principal in these 3 programs, 3 products, will come at the end of the tenure. Okay? So you get the entire money and the principal at the end of the tenure. Okay? So there is no processing fee in this. Typically, for every transaction that you do on a platform, there is a processing fee. Okay. Now, having said this, it doesn't mean that the platform is not available. Platform is still available, but unless and until you have a large corpus, my suggestion would be that don't dabble in customers on high risk on the platform. If you want, you can always take a low risk customer and pick up few of them, 100 of them. I think you'll make some money, but don't invest a lot of money in high risk borrowers if you don't have a large corpus to invest, right? So it's important to kind of note that. All right. Okay, so this is just a representation of the same thing. So you put 10 lakh rupees. There's a tenure of 6 months and 1 year. ROI offered is 11 and 12%. Gross return that you're going to make is 7.3 here. And 15, let's say 15.64 here. This is whatever that we have seen in the past data. There is no processing fee. Then there will be a default, right? So there will be a default of a couple of percentage or whatever, and you minus that with the net gross return that you made. You kind of lender gets 5.5 and 12%. Right? Now in this, the important thing to realize is that if we make more than 12%, let's say we make 13%, we retain that 13%. However, if we don't make 12%, we make 11.5%, let's say, or 11%. The entire 11% will come to you. So we basically make money only when we perform. Okay, so it puts a lot of pressure on the organization to kind of perform, to kind of make sure that we put the right set of borrowers. So this is how we put our skin in the game, that we make money only when the portfolio performs, right? And most of the lenders on the platform today has shifted to this program, because volatility is something that they were a little scared of, especially during this time, pandemic time. People delay, people default, all of that happens, right? So on a large pool of borrowers, the impact of lenders is very negligible. So from that point of view, I think, and that's the reason lenders kind of moved on to this program a lot. Okay, some of the data that I'm going to show is the performance data, which is not very relevant actually, if you ask me. But I'll just skim through that just to kind of tell you, and it's a little outdated, that data, right? But before that, quickly, how as an organization we're ensuring that we'll be able to give a return. One, I told that we looked at data historically and figured out, we at least gave lenders on a portfolio basis, we are kind of given lenders 14%, 15% return, right? So from that point of view, we're very confident about to run this program. The approach in this program is very conservative. As I said, that we have very strict rules right now at the bureau when we onboard the customer, which I talked about. For example, someone who's defaulted in the past never gets on to this particular program. Someone who is delayed, more than 30 days in the last 12 months and more than 90 days in the last 24 months. Okay, both the rules apply, not either or. Anybody who does not have a personal loan, he has not taken a personal loan, or who's not has a credit card, or someone who's new to credit, okay, who's just started his journey with credit. All of these customers are knocked off, right? So certain cities, certain type of customers coming from a certain industry at this point in time, and the COVID and all, a lot of industries have gone a little bad. So those industries, all that logic is applied before we kind of So the portfolio build-up approach is very, very conservative. It's all analytically driven. Analytics also monitors, the performance with respect to, collection and all the strategy required for that particular collection. So we do a lot of early mornings and all that. Try to figure out who are the customers going bad, who's a customer whose score has gone down, whose customer has taken another credit card, who has taken another loan, who's inquiring for more loans. So we look at all of this data periodically, month on month, month after month, which helps us to kind of form collection strategies, who to kind of put pressure more on to kind of make sure that the money is getting back, right? We also closely monitor the data sources, the sources from which the borrowers are coming. If we find any data source which is not doing better, we kind of weed that out. Someone which is doing good, we enhance that. We also try to kind of mix the borrowers better, which I talked about earlier. Diversification across various segments, different types of borrowers. And also, time to time, we will, recalibrate the portfolio. So if you see that the portfolio is getting, let's say, smaller tickets and lesser on, longer tenure loans, or for that matter, portfolio is getting too much on high risk and lesser on low risk. So time to time portfolio, calibration has to be done, right? That's really important. The other thing, as a philosophy, what we've done is that any interest that we make out of loans which are high interest, right, risky borrowers, okay, will go to non-risky borrowers. Okay, so that's what we've done. Okay, so one of the things that we've done is. All right, so some data with respect to performance. This is how. So this is a little dated. So this has gone beyond 50 crores now. This is a little dated. We just started in October of last year, just around when the COVID got settled a little, and this is where we hit the second wave also. This side. June we have crossed 8.6 crores in this, so we have kind of scaled that back. Lenders again came back and kind of started putting money in this, right? So till then we were consistently growing, and then from there, this is just one of the programs that we run, guys. Huh? So there are many programs that we have. So we've kind of, according to the partner's request, we allocate a kind of program and kind of talk to them. This is the channel distribution, various borrowers, type of borrowers that we get from different channels, the pre-approved, payment wallets, organic, organic are the ones who come directly on our platform, then third-party data, all of that. Right? This is how the portfolio mix has moved. October, we have mostly, 10% to 12%. And if you look at it, it's kind of started to move. So basically, we started off with very, very safe customers. So we wanted to kind of base of a very, very safe customer. We did that till January. And we keep on quarter, we keep on kind of putting more, money on this on every quarter. Now, one of the reasons that this is important is ultra safe customers is because your bed has to be very strong, right? So these are long-term loans. The sustainable amount of money will kind of start coming from there, right? And after that, you can dabble into 13 to 15%, and take shorter tenure loans as well, right? And this lift that we got was because of the COVID, so we got a little lift. The overall portfolio currently stands at 13.07. It's around the same at this point in time also. I'll, further data will kind of tell you that. Because this is, as I said, this is a little dated slide. Okay. This is the mix of 6 months, to 36 months from a tenure point of view. So you'll see, more than 40% of the people are between, 18 to 24 months. Now, obviously, your question will be, why is it that? How is it that when you're taking money in such lending long term and taking money short term, how will you return the money back? So the answer to that question is that this is just the bed. I think the pillars and the other things will get made on this, right? So we are not going to look at short term loans, short term borrowers. You will see this getting populated a lot now as we go forward, right? Not that this will left alone. This will continue to kind of happen because this is what gives us a stable return over a period of time, right? So it's important to kind of have a good mix of borrowers. Okay, this is on the bureau score and the ticket size. So the ticket size is around close to 2 lakh rupees, and the average score is 693. This is the average score of entire people who are in this portfolio. It's 693. Majority of them, around 36% of them, are between 750 to 775. You see this data. And the split between salaried versus self-employed is 36 in salary and 63. So we are more skewed towards the self-employed people. Because right now the view on salary is very difficult to take because you don't know, due to COVID, businesses are not doing well, people can't lose a job. But self-employed, you pretty much know. The guys who are opened their shops and they're working, or the people who are working, they're making money. You can clearly see that through their bank statement, which is sometimes very difficult for a salaried person to kind of assess. So it's important to, so maybe once this stabilizes, all the COVID issue and all gets over, and people kind of employment gets back, then you might see this mix. When we started, maybe the mix was a little different. Maybe the mix will change to maybe 50-50 or I don't know. But still, we like self-employed more than salaried because better salaried people take loans from the banks, right? So but banks don't give shorter loans to small loans to a self-employed. So there are a lot of good self-employed people who are left out with the banks and NBFCs. Okay, this is the borrower attribute, age, gender. I'll not take much time. The majority of them are between 30 to 40. Gender, most of them are male. Qualification, 60% are graduates. Employment, most of them are self-employed that we are currently doing, right? This also I talked about. We're geographically spread. We don't concentrate on one particular city. If you look at this data, so the darker ones are the ones where we are getting more borrowers from. Okay, that's only tells us. This is a typical borrower, salaried borrower, how he looks like. 31-year-old male, staying in Nagpur, working in Vidarbha Builder since the last 9 years. So it tells us the stability of the guy as an HR manager. He draws 35,000 rupees. His average quarterly balance around 15,000 rupees. He has a home loan last 4 years, paying regularly. He has borrowed 50 lakh rupees and paid 15 lakh rupees without any delays ever. So he has served a variety of unsecured loans in the past. This is a typical borrower profile. Pretty much 70-80% of the borrowers come in are like this. That's what this means, right? Similarly, on the self-employed side, average age would be around 30-35. Runs their own business, either a shop or small business. So this guy is a cattle feed business that he runs. Have their own residence and business premises. They file GST, so all of that is required. GST file and all filing is regular. Average quarterly balance is 45,000 rupees. Turnover is 7 crores. Profit margin. So these are businesses under 150 crore. Most of the borrowers that we look at are self-employed are under 50 crores. Profit margin of 10%. No check bounces last 1 year. 60 lakh borrowed. and 30 lakhs he has paid in the last 5 years. There is no DPD, not a single, this thing he has delayed, right? Payment he has delayed. Yeah, so this is how we look at the, he's taken some business loan also of 12.5 lakh rupees. So that gives us confidence to kind of give him a loan. So all this data is visible on the bureau for us to kind of, that's what I said, a lot of behavioral, this thing you get to know from the CIBIL data. This is nothing but, how the portfolio is doing. This is the gross return. And this is the, adjusted return after default. And this dip that you see here was because of the COVID, and we are getting back. So this is data till 24th, I think, of last month. So a little dated data. So recovery has gone better. So we moved up. This curve have moved up to beyond 13% back again, right? So the team can send you an updated one if you need. Yeah, so there's the same thing that we collected. 96.37% pending is this much. From an amount point of view and the count point of view. From an amount point of view, it's 2.848, and from a count point of view, 3.6963 lenders are delayed. And this is the breakup. Who is sitting in which bucket, right? So 90 plus is the one which gets stickier and becomes difficult to collect. So it's 0.47 on count and 0.36 on amount. Now, on a portfolio of, this was 36 crores, right? This is the figure. Now, the thing is that, the profile of the borrower kind of keeps changing as the environment changes, right? If the environment is not changing much, then pretty much everything is, nicely, paid back by the borrower. Because we're onboarding only good borrowers. We're not we're weeding out all the bad ones. So from that point of view, I think it starts to kind of make sense. I think that's about it. So quickly, recognition. So we've kind of recognized by a lot of international bodies and organizations and Indian organizations. We were in a NASSCOM 10,000 company. We were invited in Dublin for a web summit. One of the companies got shortlisted. One of the fintech companies got shortlisted. We were, NASSCOM's 50 most innovative companies. We are also, a super brand. Super brand had selected as a super startup. I don't know what that means, but they had given us an award for that. We also won an award, which is an international award for our, technology. This award was given by Interbrand, and the award is basically, they don't kind of call you or anything. They look at technology across the world and, to pick up various organizations and, give it. So during that year, Zomato and us got it. So they do this in partnership with Facebook and New York Times, right? New York Exchange. So it's a very prestigious award, actually. And we also have been Microsoft startup, right? Incubated under Microsoft. So that's the and one of the case studies of ours has been, is there in Harvard Business Review. This is done by IIM Bangalore. They believe that we're the only ones who are doing a classical, two-sided marketplace in the financial services domain. There is nobody else who's doing. So they moved around across to all organizations, starting from Paytm, this, that, everybody, every organization, and they zeroed down on us, saying that you are the ones who are doing the classical way, the right way. A P2P lending company or the financial services, two-sided marketplace has to be run. So both sides, large number of customers. So that's the reason they did that case study, and it is on Harvard Business Review. If you have to read this, you have to pay some $9. Okay, these are our investors. So Mohandas Pai is our advisor. He's also invested in the company. We have a bunch of angel investors. Some of them are great friends. Some of them are mentors. Some of them are bosses that we worked with. And we have some, very marquee investors, right from JM Financial to Muthoot, RN Capital, all these guys. Recently, we raised some money, and that was through ICICI Bank. So now, this is the first time I think in any P2P lending, a bank has taken a position, and it was Fairstone that they did it for. Okay, that's it, guys. So I think I'm done with my presentation. So if you have any questions, I'll be happy to kind of answer. I don't know, a lot of people have left, but...
Yeah, please mute yourself and ask questions.
Yeah, good evening, sir. This is Purushottam, sir.
Yeah, please.
Yeah, nice to be here, sir. We had a great opportunity to hear from you.
Thank you so much.
Thank you, sir. What is the default rate right now, sir, in this last financial year or this financial year?
See, the portfolio default in this particular portfolio that we're talking about for you guys to invest is around, which I talked about, 90 plus is 0.46 and 36, 0.36 and 46, 10 amount. And if you look at the overall portfolio platforms default, historically, the way it works is that at every risk level there is a default, right? So if you look at the 10 to 14%, there will be, or 10 to 12 or 14%, there will be practically no default. Loans are structured, loans are backed by organizations. So very few borrowers are on board on that base default. Very maybe the same range in which currently the SIGP portfolio is running, right? In the simple. And when you move from 14 to 18%, there will be some 3-4% default. And historically, and if you move from 18 to let's say 24%, there'll be some 6-8% default. And similarly, from 24 to 36%, there'll be around 10 to 12% default. So for us, it is you have to realize we're a platform, right? At every risk segment, there is customers being onboarded, and there is default which will happen. And as the risk climbs, the default also climbs, right? Now, whether it makes sense to kind of put money on the very high risk and onboard borrowers, the answer is yes. Now, does it make sense for lenders to directly invest on those borrowers? The answer is no. Okay, better is to kind of invest through SIGP, because that's a better way to kind of make money, right? For at least your 12% is assured of if you're investing for a year. Now this is important to realize, because if you have a lot of money, then it is good to kind of invest in high risk. If you have a couple of crores, then it makes sense to kind of nicely you can put a portfolio. Now, if you look at banks and NBFCs, they don't play with 50 lakh rupees, right? They have a very large portfolio. And the larger the deposits or larger the money any bank has, the better the balance sheet theirs become, because they distribute that to a large number of customers. SDFC, ICICI, Axis, SBI, all these have a very large number of customer base. So they're able to kind of disburse the route to large ones. Smaller banks have a struggle, right? For example, Yes Bank didn't have a solid retail business, right? So the number of customers were limited. So you saw, Yes Bank had a little bit of struggle, right? So it's a very clear indication that a larger number of customers will make your portfolio better. I don't know whether I was able to answer your question, but
Yes,
the risk is on every this thing, and it can range. At the lowest level, it's around 0.5% and less, and it can go to 12% and above.
Yes, sir. It makes sense, sir. It's pretty good. Thank you, sir.
Anybody else?
Yeah. Hi, Vinay. Shravan here. Hello.
Yeah, please. Go ahead. I can hear you.
Yeah. So firstly, I would like to thank Mr. Vasu for introducing us a new investment instrument. And thanks, Vinay, for providing this wonderful session. I'm already registered as a lender in the month of May, second week, in May 2021.
Okay.
But since then, initially, while I was trying to register, I couldn't able to register due to, I don't know, some issue with the application. And someone from Faircent has called me up and asked. And finally, the issue was resolved, and I could able to register as a lender. But then after, no one from Faircent has followed me up on why I'm not investing any money. I could not able to understand the application. Firstly, I could able to understand, but there is some sort of fear. What happens if I invest based on my knowledge? There was some person who called me up and asked me just go with some standard safe. I think that is SIGP, I guess. I don't know. I kind of totally forgot how the application looks like now, because least follow up from the Faircent team. I'm actually eagerly waiting for someone to call me and explain me, or at least like Policy Bazaar, right? They will sit with us virtually and guide us through the application how to invest or how to purchase the insurance. So if someone from Faircent guides us that way, at least for the first time, then we will get habituated or we will be familiar with the application and kind of get in touch with the application, and we will get interest and we will continue to invest long term.
Sure.
This is one concern I have, and other thing is the SICG. What is that? SI?
SIGP, yeah.
Assist. Yeah. So will we be having a transparency on that SICG feature?
Yeah.
On it is up to the Faircent to where to invest, right? So will we be getting what transparency on what kind of percent risk or interest rates you are investing in? How are you dividing money and investing in what kind of percentages basis? Will we be having that transparency?
Yeah, I showed that right now on the my slide. You saw that in the different interest buckets how this is moving, right? One, it has a limitation. It cannot go beyond and it cannot go over, right? A particular risk. Okay, that's the call that we have taken in this one, right? So if you saw that it started with 10% or something and kind of got over at 24%, right? So that's the range in which we are operating. Now it's that the money will move in various buckets of these 10 to 24% range, right? On a flat it will be around 14 to maybe 16% range. So that's the range in which the money is going to move. Now, why this is important is because you can't have just a long-term loans taken and promising lenders, short-term returns, right? So I can't, take money on 3 months from my lenders and lend it out on, let's say, a long-term basis of 3 years, right? Lender comes and asks money, I won't have the money to kind of give it back. So it's important to kind of calibrate that. So you will see initially a lot of borrowers on the, as we in the last 6 months we've been kind of building the base, as I said. Long-term loans. That's the reason average is still around 2 years. But now going forward, you'll see shorter tenure loans, right? 12 months loans, 6 months loans, even 3 months loans, shorter tenure loans you will see, right? These business borrowers have a lot of short-term needs as well, right? So quick money for doing some transaction or, buying something. There is a lot of cash flows, issues these people have. So to manage the cash flow, they need kind of money in order to kind of, so you will see a lot of short-term loans coming in the days to come. As far as the visibility is concerned, this particular deck that I presented, we have a deck from our risk team which comes out every month, beginning of the month for the previous month till the previous month. That is shared with all customers who are investing in SIGP, right? It goes to all. So that gives you a complete transparency how the portfolio is doing, how the thing is performing. Within, as per your investment is concerned, which borrowers that is going to go to, that also is visible on the dashboard that you will get once you start investing on this platform. So visibility with respect to how the risk is moving, as we go along, even that visibility. Also, how the collection is happening. Till now the outstanding is not very large. But as we move forward, obviously the collection and the outstanding also will become big. We will bring in visibility for that as well. Apart from what are the changes that we are bringing about in the risk, we'll also kind of take you through about on the collection side. Answering your first question. Okay. When we started our journey, Shravan, we did a lot of handholding of the customers, right? And we still do it. It's not that we don't do it, right? My apologies that people didn't kind of reach out to you and proactively kind of took you through the entire process. But as an organization, as we move forward, right, we want to kind of make this more easy for the end user, right? It should not be that I have to kind of, because I might onboard a lot of customers as we go along, right? So, for example, one of the conversations that we're having is that they're talking about onboarding. It's a neo bank. They're talking about onboarding close to maybe 10,000 borrowers a month, right? Now, if I have that kind of flow of borrowers coming, the process has to be so smooth and transparent that the lender is able to kind of figure out and kind of take it forward. Right? So for that, what we are also doing is that we're creating a different app for SIGP. Right? So you don't have to kind of come to Fairstreet app to kind of do that. You can download the SIGP app separately, so you will get all the visibility, all you can invest. So what that means is that the dependency on people, okay, to kind of tell you something will be cut out as we go along, right? And why that is important is because one, we kind of brought in those people to kind of educate people, the customer. That education and that everything has to kind of move online for the customer to kind of understand and take the journey forward. Now, why that is important is also because a whole lot of bad things or fraud or anything for that matter could happen in these transactions, right? It could happen from people who are working in my team. It could happen with people working in my partner's team. So it can happen anywhere, right? You never know what is the intention of the other person who is trying to kind of do it. So the more robust your systems are, the better it is. Same thing happened with Zerodha. If you saw Zerodha, when they started, they had a lot of people, right? We also had a lot of people when they started, and as they move forward, they kind of started to cut down on people. Initially I had downloaded Zerodha a long time back. Nobody called me back then. I got a lot of calls, in fact, back then about. This was about, I think, some 3-4 years back, right? I got a lot of calls from them. I think more than 4 years back. I think 5 years back, 5-6 years back. And this time, I revived that app again, and I put 10 lakh rupees there, right? I didn't get a single call from anybody. So that means they've evolved. Now, in that process, the app has become very nice. The journey has become very smooth. All of that happened. But having said that, we'll make sure that somebody calls you. Okay.
Sure. And one fundamental question. I think I'm not sure if you have talked about it in your presentation. What if a borrower passes away, expires after borrowing some money?
So from a contract point of view, if you look at it's an obligation of the borrower to kind of pay the money back, right? And if he is no more, or if he cannot pay or whatever, then his next of kin has to pay. Okay, his father has to pay or his son has to pay. So it's not that the loan is going to go away from that particular person or the person's kin. So when he's signing the agreement, he is signing an agreement with the this thing of kin, right? Next of kin will take it up if he's not able to kind of take it up. Okay. Having said that, we are also initially what we did was that we were doing insurance, individual insurance. People who wanted to kind of take insurance could take insurance, but very small percentage of people took insurance, right? And before that, what we did, we kind of forced insurance and dovetailed into the pricing to it, which IRDA didn't allow. Now you have to explicitly kind of ask the customer to kind of buy the insurance. If he's not buying it, then the customer will not, but we are not supposed to do that as per the law. So now what we're discussing with, I think this should go live by end of this month. We are, or rather mid of this month only. This month itself it will go live. We are bringing in group insurance, into this, right? So and that discussion started, in the first wave of COVID. We wanted, because we were anticipating, people to die. Not that we wanted to, but there could be an eventuality of people, dying. We should not have a situation where the lenders are losing money, right? So we brought in this group insurance kind of thing, where the portfolio is protected by the entire this thing is protected, and the standard there is a rate that we are taking from the borrower for that, so the rates also have come down because of that, and we will see a larger adoption there. And we're not giving this time, at least the insurance company says in the group insurance, you don't have to really kind of give that option to the customer whether he wants to take the insurance or not. You can kind of take it out from his processing fee. So I think from next month onwards, all customers who will be onboarded on Fairstreet will have insurance along with it. And insurance is not standard 1 lakh insurance. Insurance will be on the amount of money that he's taking from the platform. So if he's taking 10 lakh rupees, the insurance will be of 10 lakh rupees. The earlier one, we had fixed average, let's say a lakh rupees or 2 lakh rupees if the average ticket size was in the platform. We just had 2 lakh rupees as an insurance for everybody, right? So it was just, someone had to click it, we kind of have customized. So group insurance, you don't have to do that. Depending upon the portfolio size, the insurance company will take the premium and they will pay off the money which anybody dies. It's only on death. So earlier we're trying to kind of do something else also, but we are not wanting, right?
Yeah. Thanks. Got it.
Hi Vinay, this is Amul. Thanks for your time.
Hi Amul.
Yeah. Some basic questions from my side. What is the minimum amount? For the investment point of view.
See, the minimum amount in this program is 1 lakh rupees, and that's where we start. And once you put 1 lakh rupees, then subsequent can be as small as 25,000 rupees.
Okay. And it should be locked into some duration or something like that, or how it is?
So that's up to you. If you want to put in 3 months, you want to put it in 6 months, you want to put it in 12 months. It's up to you.
Okay.
So the day you transfer the money to us for this program, your count of whatever interest, it starts on that day itself. It starts from that day. So even if we are not able to deploy, you will get your interest. Because if you see during COVID, we had lenders putting in money, but we were not onboarding a lot of borrowers because the good borrowers suddenly disappeared because of COVID fear. They want to they want to kind of conserve cash and they were not wanting to consume, right? So due to which we saw a lot of consumption going down. Okay? So if you don't have borrowers and the lenders are putting money, so we had a lot of money lying in. So it just doesn't mean that just because there is a lot of money with us, we'll start distributing that money. It doesn't happen like that. So whatever money that you put, the day you put money, your meter will start. Okay, you will get exactly after 12 months or 3 months or 6 months, you will get your interest on that with the principal. And you have the option to reinvest the principal. You have the option to kind of withdraw the principal.
Okay. Yeah. And one more thing, from the general public point of view.
Yeah.
So, I have invested like 10 lakhs something amount. You have given for some borrowers or something, multiple people. Yeah. But let us suppose, they ran away or something. Who will take the responsibility? Is it the Fed cent or it is again RBI guidelines? Those all things you have to follow.
So default and all that is our responsibility, right? Now, that has nothing to do with the return that you're going to make. Let's say if 10 borrowers run away, you will get your 12%. That has no bearing on you. Now, if you don't work on those borrowers who are running away, it's that most likely it's us who will not make money. And we don't do that, right? So we want to make some money. We're in this for making money, right? So it's important for us to kind of push that envelope also. Okay? Now, what we've seen is that in our case, the situation of running away does not happen. The situation, because we validate the customer that much to ensure that the running away customer is not on board. We can have a situation where the borrower is not able to pay.
Yeah.
The reason could be, health reason, or it could be his business loss, or it could be his job loss, or whatever, right? Could be reason for him not to pay. So you wait out, right? You kind of have a conversation. As long as the borrower is having a conversation with you, he'll pay. The people who stop doing conversation are the ones who typically want to kind of avoid you. For that, we quickly move to the court, okay? And we go do the criminal case, we do the legal case, and we issue. We do.
But at that time, I want my money back as something that Crescent will give back it, or I have to wait for the court.
No,
those all
that
things.
Has nothing to do. That's why I said that has nothing to do with your returns. If you have put in 3 months, you will get your money in 3 months.
Okay.
So the only difference between the bank and us, Shaman, is that you can see the money which is there in your bank account. Here is the escrow account, and what is the money going away to get lent? The amount which is getting to lend. You can see that. In the bank, you don't see that, right? If you have a 5 lakh rupees in the bank, it stays there only. Only when you withdraw, it comes down. Only when you put, it goes up, right? The banks at the background is taking your money and lending. We all know that, right?
Yep.
The bank is not transparent about it, okay? But in this case, you'll exactly get to know where your money has gone, which borrower the money is given out to. So that transparency we will bring in. Okay. But the return that you're going to get has nothing to do with these borrowers that you invested.
Yeah,
The
yeah,
return
that
is
I
the
got.
cumulative return of the pool or the portfolio.
Mhm.
Suppose if this portfolio is 1,000 crores after a couple of years, let's say, right? Whatever is that pool's performance, you will get return basis that. It is not 5 borrowers that you invested in or 10 borrowers that you invested in.
Mhm, mhm. Okay.
That is the fundamental. So we will do our, chasing or whatever. It has nothing to do with your money coming back to you.
Yeah. And one more last question. Like, I mean, you said, like, I mean, 75% of the market share. I mean, it is globally or India-wide
No,
or
India.
state-wide?
See,
India.
India, yeah. Financial services is a regulated business across the world.
Mhm.
So you will not have many players, jumping one country to another, right? So you will not have suddenly a US P2P lending company and coming and opening shops here.
Mhm.
Even if they do, they will have to integrate or do some alliance with some of the local players, right? Or take over a
Mhm.
local player. Only then they can conduct. But being, since it's a regulated business, especially highly regulated business by RBI and this thing, it's a little difficult. So it's just like a stock exchange, right? Stock exchange is a regulated business by SEBI, right? You don't have a New York Stock Exchange come and open an office here, right? It's a very regulated piece.
Yeah, yeah. Okay. Thanks, Vinay.
Thanks.
Hi Vinay, this is Subramaniam.
Yeah, Superman. Tell me.
How to reinvest amount? For example, if I invest 1 lakh in SIGP, right? So how to reinvest that returns? I mean, interest calculated on daily basis or quarterly?
So I'll tell you what. So you don't reinvest. Okay, we reinvest. So the money that you give 1 lakh rupees, whatever EMI that comes back, it's reinvested by the technology itself, right? Onto those borrowers which is assessed by technology. Okay. So what you can do, a lot of lenders do this, right? So, for example, you invest 1 lakh rupees this month. Okay, you invest another lakh rupees next month, another lakh rupees next month, another lakh rupees going, like that. So if your program is 3 months, let's say, right, or 6 months, whatever your program is, let's say you picked up 3 months program, you invest 3 lakh rupees month after month. Now the 4th month, your first, lakh rupees interest and principal is ready, right? So you can leave the principal and withdraw the interest. Okay. Next month again, the 2nd month's interest, the 5th month, 2nd month interest will get due. You can take interest and leave the principal behind. Now, what I'm trying to say is that after the 6th month, every month you can keep taking interest, just the interest part.
Okay, interest part. Okay.
You can leave the principal behind. So that whatever program that if you're doing a 12-month, you have to do 12 months of SIP or whatever you may want to call it for easier term. So you invest every month, and the 13th month onwards, you'll start getting the interest for the first month if you want to kind of keep the money back, and that money will go back again and kind of deploy policy. You can. So we will maybe eventually create a product of that kind also. It will have a longer gestation, have a 2 year, 3 year.
And interest calculation on quarterly basis or
Monthly basis.
Monthly basis. Okay. Thank you.
Hi Vinay, this is Mahesh.
Hi Mahesh.
Yeah, I have one doubt. So the interest which we earn, is it limited to 12% or depends on the borrower?
No, this is in this program. It's a fixed 12% return or 11% depending on the program that you want to take, tenure that you want to take. It is fixed at 12% for lenders.
Okay, whoever the customer invests, it is for the 12%, and the remaining organization will be taking the risk and be giving for the 18% or 24%.
No. So organization will be investing in borrowers 18%, 24%. You're right.
Yeah.
Including 11, 12% to 18% borrows also. So whatever risk is going to happen, the organization will take, right? So they will manage with that portfolio. Okay, so lenders don't have to worry about that. Lenders will get that 12% in this program.
Yeah, got it.
So if we are able to make, let's say, 15% out of the program, let's say, okay, after doing everything good work, so I will retain 3%. 15 is a very ambitious number, but I'm just to kind of give an example. But if you're not able to make 15%, let's say we're able to make only 11%. Instead of I promised you 12%, but I'm only able to kind of make 11%. All that 11% will go to you. I'll not make anything. So it's in my interest to kind of make sure that this works. If I have to make money or if I have to earn, I have to make sure that this works for me.
Okay, okay. Depends upon the organized financial status.
No, not the organized finance status. Organized finance status has nothing to do with this. Portfolio's, status. How
Okay,
the portfolio is performing, based on that, everybody makes money.
Yeah. Thank you.
Hi, Vinay. This is
Hi, Krishna. Krishna, can you hear me?
hello. Am I
Yeah.
audible now?
Yeah.
Yeah, I have one question. Like, suppose I invested some amount with the tenure of 3 months or 6 months. So the tenure completed means that principal and interest will auto return to our account automatically, or do we need to take any action on that?
No, it'll come back to your escrow account, your wallet.
Okay, so the respective organization wallet. you mean.
That's right.
So from there to our SP accounts or saving accounts, how can we get those money
You
from?
just have to click a button, it'll come back. Just like the Paytm, the way it works.
Okay,
You just click a button, it'll come back to your account.
okay, I got it. So
You also have the option to reinvest. So if you click that option of reinvestment, the money will go back. And if you don't take any action, still the money will go back after three months or something, or three days or something.
okay, so
If you forgot and come back after some days and say that, boss, you have not given me return. I have parked the money for 12 months. I have to make sure that those terms and conditions are mentioned there.
yeah, so in that case, do we get any interest add-on during that idle state of those?
No. That's the reason it's going back, right? So escrow does not yield return. Only borrowers yield return. None of the escrow account, gives return.
Okay, thank you.
Yeah, Vinay,
So
this is
hi.
Mahesh again.
Yeah, Mahesh, you can ask the last question because it's already 1.5 hours. So we'll end up this session after this question. Okay? Fine. Yeah, continue, Mahesh.
Yeah, sure. So we have a renewal fee, like we have fee, right? Registration fee. Is it for the one time or it's annual registration fee?
As a lender registration is a one-time fee.
Okay. Thank you, Vinay. Thanks for your patience.
Thank you everyone for participating in this. Vinay, would you like to tell anything?
Yeah, there's some people who had written few messages. Some of them, I think, were not following English. They said Telugu or Hindi.
Okay, fine. I'll explain. I will take one more session to these people and then explain in our question answer session.
One of the questions that people, Appa Rao asked is what is the difference between a mutual fund and P2P? Okay. So from an investment point of view, I think unless you're taking a debt mutual fund, if you're doing equity mutual fund, this is stable. This is a stable investment. So there is a fundamental difference between debt and equity, right? The equity is dependent on the company's performance, and debt is individual, right? Signing a contract, right? So which you can take it to the court of law. If the company is not doing good and your stock price goes down, you can't take anybody to anywhere, right? So that's a fundamental difference. There is, apart from if you're taking debt mutual funds, then I think it's the same thing, right? So debt mutual funds are also backed by contracts and papers and all. Similarly, here it's backed by contract and paper. So there is a law to take care in case if the contract is not honored. So that's a fundamental difference. There's a question on pre-closure of the borrowers. That has nothing to do with in this. There are very small percentage of people who pre-close, and that will be absorbed by us only. So you don't have to your returns will not get impacted with that, any pre-closure. Will there be any tax on this return? Yes, there will be tax. Till now, all the interest income that you make is taxed. Similarly, here this will get taxed. However, there is a law in UK and Singapore, and I think in Australia also now. All the Commonwealth, I think countries are now getting into this. So any investment that you make in P2P lending companies, especially going to micro SME borrowers, you get interest rebate on the interest that you make, right? So there is no interest charged on the interest that you make, or the tax charge on the interest that you make. So that's a law in the UK. So we think in India also that'll come. Maybe it'll take some time, but it'll come. I think it makes a lot of sense for the government, for people to help the micro SMEs. That micro SMEs is what becomes an SME, and that's how the growth of the company and the country happens. So a lot of employment happens in the micro SMEs, right? I think close to 30 million people or 35 million people. I think maybe more. I'm getting the numbers wrong. People work in the micro SMEs, large numbers. Right? So if you have to uplift them, the organizations for these people to kind of continue to kind of make money and all that, lending is an important source for them to survive, right? So it's important. Now, if as a community people are lending, it perfectly makes sense to kind of discount that interest the lenders make as tax-free. I think government likes the idea. It's a question of time and priority. That's all. There's another question. 10-year investment I covered, 3, 6, and 12 months. That's a 10-year investment. When the lender increased and the borrowers are less, how can you pay interest? No banks and BFCs offered this type of interest. Why? So it's not that we don't have borrowers. It's just that when the consumption of the borrowers go down, it's then you find difficulty in finding borrowers, right? So, for example, if the shops are closed, he does not require any working capital, right? So that's the time when it goes. That is only time, a couple of months, you'll have a scenario where you have increased number of, supply and the borrowers are not there, right? But if you look at it today, bank situation is that, right? So on one side, banks, a lot of money is coming because all the salaries are going on and banks not lending, right? They're not very aggressive lending at this point in time. Banks do this for a longer period of time, okay? The rate of interest banks are offering is less, not because of the structure the banks have, because the cost of capital is very high there, right? You have to understand this, right? Banks, the money changes hands a lot, and there are CRRs to maintain. Okay? All of that is there. That's the reason the cost goes up. It's not because banks can't. Okay, it is very simple. If you're lending at, also we lend at a little higher rate of interest than what the banks are. Banks are lending at maybe less than 24, less than 18%. So we go up to 24%, maybe up to 36%. What I talked about. Now banks don't do that. Banks don't do that because if the default rate climbs up, the cost of capital further goes up, right? And they restrain the NBFCs they're giving out money to also to kind of not go beyond 24% again, right? That's again contracted by the banks with the NBFCs, and that's the reason I think. And if their default goes up, again the cost of capital for that NBFC might go up, right? And that is the reason all this moratorium thing and all that is getting pushed out, so that they don't want to show it as a default. All of that is happening because they know if they do that, the cost of capital will go up, right? So everybody will be made happy, everybody will be paid, government will take a hit, SBI will take some hit, all of that will happen, RBI will release some money, liquidate a little bit, and everything will be fine, right? But the structure is such that the banks are not able to kind of do that because it changes a lot of hands. That's one. Second is that if you look at bank structure, they are more branch model, right? So there are lots of branches, of 3,500 branches of ICICI that I heard of last time. So to manage that, to run that, people, the executive vice presidents, the directors, all of that is there. We don't have any of that, right? So all that is what we pass on to our lender. So if this lender is, ready to kind of give borrowers at 12%, let's say whatever, if you give 12% to the borrower, I'm able to lend as much as 24%, let's say on an average. There is a spread that I'm making, right? And that is what I'm passing on to my borrowers. So it is globally scalable model. This is scaled up across the world. India is not. China it scaled a lot. Everywhere it scaled a lot. And by the way, NBFCs aren't doing as much as from business model point of view. I'm not talking about the fintech NBFCs, but the NBFCs. Some of the fintech NBFCs do a good job, but a lot of NBFCs have narrowed their approach with respect to the borrowers they onboard. Right, so they will be either doing only business borrowers, or they'll be doing only equipment finance, or only certain things. So if that industry or of that or particular this thing goes bad, the entire portfolio kind of goes for a. So their model of making money is quite tight with respect to the external environment if that plays out bad for them. Okay, and when it is good, then they all make money, right? So, but we are not like that. We are a technology company. We kind of take borrowers from across the portfolio. So this is Raju's question that I'm answering. So the nature of the business, gets us to kind of bring in a lot of borrowers who can give us a larger sum of money or a larger rate of interest. Otherwise, they would have an option to kind of give right now. So they don't have an option. Banks are not at all interested in giving out a loan to a small businessman, a 2 lakh rupee loan or a 1.5 lakh rupee loan or a 3 lakh rupee loan. They're not interested. So is there an option to break the investment before the maturity period? Answer is no. You cannot. 3 months is the minimum. We are also bringing in another product. I think it will take a couple of months, which is a 24-hour liquidity product. But the rate of interest will be around 7-8%, right? So 7%, I think. So there you can get what you're asking for. You can take the money out anywhere whenever you feel like. All right. So any other questions, or shall we call it a day?
I think session is over. It's a long session, I can say. Thank you so much, Vinay, for your patience. Yeah, took we planned for 1 hour and it took 1 hour 40 minutes. Thank you. Thank you so much.
Thank you so much.
Yeah, we are ending this session for now. And if any questions, we gave a link here. So I'm going to give you a link in the WhatsApp groups. So there you can register your question. And one of the partner from Faircent will call you and explain you in detail what to do, what not to do. So if you would like to do investment,
open up a camera. Kiran, why don't you open up your camera? So Kiran is the one who manages Hyderabad for us. So he's the one to catch if you want to kind of get some more clarity or some more. Yeah. Kiran, why don't you say hi to everybody?
Hello everyone. You can reach me out Vasu sir and we both coordinate, and you can reach me out through Vasu sir.
I already gave appointment link of Kiran along with the form. So if you fill that, automatically Kiran's appointment link will appear. You need to just fill it. You have to select a time and date. So Kiran will be in touch with you at that time. That's it.
All right.
Yeah. Thank you. Thank you so much, everyone, for participating in this. And thank you so much, Vinay.
Yeah, thanks. Pleasure. Thanks a lot.
Thank you.
Great.